Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, May 24th, 2022. What I'm going to do in this one is just stick to the equity markets, and I'm going to be very concise. It won't be a very long video. I do want to go over some charts, many of which is the same. I've got a few new things to show you, and I'm just going to, be very clear up front what my thoughts are, and the case that I'm going to make in this video. Um, uh, the Right now, and it really at any point in time, I can tell you, and I've said this in the past, at any point in time, you give me any security, an index, a commodity, whatever it is, and I can sit there and make a bullish or a bearish case. Kind of like the debate club in high school. You're given a topic, you either defend or support that top, or argue for or against it. But that does you no good. I will show you, I will point out things that I believe are bullish or potentially bullish and potentially bearish. I will quite often lay out alternative scenarios, showing you one arrow going one way, one arrow going another. But very clear, I'm not just, well, the market can go up or it can go down. Those scenarios are always contingent on something happening. For example, today, the break of the recent lows, bearish. And we probably go a lot lower if that happens. Whereas if we go up and we take out the resistance levels overhead, I think it can spark a nice rally, a tradable rally. Right now, I'm leaning that way, but let me be very clear. So I am long. I remain net long in the equity as far as equities go. I have other things balancing those out, or somewhat hedging, and those are longs in treasuries and gold, which I've actually paired a little bit back. Had to roll the treasuries there. Everything was rolling today. The futures are rolling. So I'll pick up some of those that I closed out today. I'll get back in those tomorrow or tonight or somewhere. But where I was going with the equity markets, it is I am net long, but it is far from an all-in or very bullish moment. Okay, so I'm going to go over the reason why I think the risk reward is skewed to the long side, why I think we may see a rally here soon. And again, I'll give you the contingencies that will really chip away at that. So all in all, today was not a bullish day, especially on face value. At least, we can all take what we want out of anything. Some look at the glass half full, some look at the glass half empty, and I'll give you both sides of that. But the Qs were down. The Nasdaq 100 was down 2.13. So there's no way to spin that as bullish per se, right? The only bullish thing I see in that is we defended. We came close to the lows, those recent lows from Friday. Last Friday, and we rallied to close, recoup a lot of the losses. So again, if you want to look for the positive in something, you want to be that optimist, or at least in analyzing the charts here. Yeah, the fact we defended the lows. I would give a check mark to the bulls. The fact they took the market down another 2.13% and were came within basis points of a 52-week or multi-year low. Yeah, sure, the bulls are in control, and I said that before. There's no hard signs of a bottom here. I don't see any very clear bullish reversal, candlestick reversal patterns, or anything else that's really indicative of a bottom. But the case that I'm laying out, and I'm going to make and continue to make in this video, is I have many, not all, but many key indexes, key sectors, and key stocks at or just above support after recently hitting those key support levels. On the flip side, I have quite a few that are close but not there yet. And that sometimes when I see that, that's indicative you're getting close to a bottom. Some things are hitting those support levels like Amazon and some others that have hit and held support. And maybe we need that final washout move down, which could be, again, I try to quantify everything in risk reward perspective, probably just a few percentage points in the market. And again, I'll get to that in a second. So it's all about risk reward. So at this point in time, you can never rule out a crash, especially with what's been going on lately, especially with the things I talk about a lot of hedge funds and pension plans and institutional fund managers being caught off guard and pivoting too late, taking too much, waiting to the very last second to start to get out of heavy equity skewed positioning, waiting till the Fed was, Fed was announced this, even though they didn't do anything, they started pivoting back last year around November, but then they started raising rates this year, and along the way they made it clear those rates are going to continue to go up. So this is a lot of this is just those that waited too long, thought for whatever reason they were drinking the Kool-Aid, and I saw it out there that, oh yeah, rates are going to go up, but the economy's so strong it won't matter. Yeah, it matters. Okay, that rates are everything, especially extreme artificially low rates. So, all right, let's okay, back to the charts here. All right, so I want to show you a few things. And again, here's a daily chart. QQQ down 2.13%. So really no way to spin that as bullish, other than the fact that we were able to remain above last Friday's lows, which, as I made the case, yesterday, that had the potential to be a bear trap because we undercut the previous low and had a pretty strong reversal to recover back above there. So this, again, not ideal price action for today, far from it, but it wasn't enough to have me pivot back to a net short positioning or to just get out. Sometimes I'll do that. If I'm not, if it's very unclear, if it's a coin toss, I'd rather be flat, and just, trade other things, gold, euro, or whatever else is out there. So there's QQQ, here's SPY. SPY a little bit stronger, and remember, the S&P 500 is more indicative of the overall economy or the overall stock market. QQQ, it's a great trading vehicle because it's skewed towards a lot of the high-flying tech stocks. So if you're right on the short bet during a bear market, you're usually going to profit more from shorting the Qs than the S&P 500, which is held up by steady Eddie dividend payers and utilities and defensive issues like that. So not such a bad day, but still down 0.75%, not too far off the lows. All right, one thing I want to show you here is I'm going to jump over to time frames. I'm going to show you. I'm going to take this, the divergence, I'm taking that away now. Oh no, we still have it. We still have RSI divergence. So there's my divergence line, divergent low 1. Remember back here, we rallied off that divergent low. We had divergence on both the PPO right here and the RSI down below. Here, I'll draw it out for you. PPO divergence, let's make that line a little thicker. You can see it clear in the video. PPO, positive divergence, RSI divergence right there. And we had a nice wedge, especially in the NASDAQ 100. NASDAQ 100 put a double bottom. This is SPY, of course. And we had that nice rally. Here, the divergence in the RSI has extended. So we have RSI divergence. Technically, we do have on the daily chart PPO divergence as well. It's just a smaller, much smaller divergence right here. You have positive divergence right there from this point to this point, and there's also positive divergence there on the RSI, so that could do the trick. And here's the thing. I've been doing this a long time, and it's not a hard rule, but it's almost a rule, and every time not every time, but most of the times I ignore that rule, I end up paying for it. And what that rule is, during a correction, now remember, we've been in a bear market. By my definition, this is all part of a bear market that started back in 08, 09, early 09. Even COVID, 36% drop in the S&P 500 was simply a correction, the way I look at the markets. I've talked on that before. So where I'm going is, the rule is, typically when I start seeing 60-minute positive divergence on the 60-minute time frame, like we did back here, and I pointed out the time, that's where I start to get ready to pivot, start covering shorts, or at least not being aggressively short and or going long, or getting ready to go long should we get a buy signal. Okay, and there are times I'll try, I'll recognize divergences and then choose to dismiss it. But again, more often than not, I get burned because those divergences play out. So that's it. I just wanted to tell you we still have the divergences. I'm going to show you on the 60-minute chart. They show very clearly there, and they're showing all the way out here on the daily. Not only that, let's take a look at this. I'm going to park the RSI just for a second to make this clear. And let me turn off all the lines, move this up. Let me add one indicator here, and that's the PPO histogram. So this is the PPO down here on the bottom. And you have your PPO line in orange, and then what they call the signal line, the 9 EMA in white. And when the PPO crosses the signal line from below, that's called a bullish crossover. And when it crosses down from above, that's a bearish crossover. And those bearish crossovers often mark inflection points in the market. There was one there. We kind of went flat for a while after the crossover. It wasn't even clear. They traded on top of each other. But once it was clear that the PPO line was starting to move down below the signal line, that's when that top was in. And so I wanted to point that out. And these are what I call hills. The PPO histogram above is simply a visual representation of how far apart these lines are. Again, the orange line from the white line. The farther they are apart, farther the orange line is below the signal line, then the farther these red bars will be. The higher you get above the white line when the trend is bullish, the higher the green bars will be. That's what the histogram shows you. And so when it crosses from green to red, that's a bearish crossover, and when it crosses from red to green, that's a bullish crossover. So not always, but a lot of times you get what I call these hills. This is a hill, there's a green hill, red hill. A lot of times you get a crossover. Sometimes it's whippy, especially after a major sell signal like we had here. But many times the trend changes. Like right here, you see a red hill, meaning you got a PPO crossover, bullish PPO crossover. I'm taking the line straight up, and then that ended that downtrend, started a new uptrend. You can go play around with this on the chart. Sometimes things are, you're in a trading range and you're going to get whipsaws. That's when crossovers, these type of bullish and bearish crossovers, don't do much. But overall, again, quite often you go back, especially when you have the large hills, those that go for a long period of time, not these little tiny choppy. Those again are going to be in a trend. You want to see the bigger hills like that. So that's it. I want to just show you that we have and I'll park this, I'll put that back again. That shows you that the PPO is pointed up right now. I'll put it back. You can see again the hills, when they come up, you're usually going to get that crossover. And so any more upside, we're going to get a bullish PPO crossover, the first one in a while. And not just on SPY, but also on QQQ. There it is. You can see the histogram right here. You can see the little crossover there. You can see a crossover there. There was one right there, and that was, gave you a trend change and a nice rally there. There was a bullish crossover here after a correction right there, and it led to this whole run up there. So that's that. That's one thing to look at, something I hadn't pointed out recently. So I'm going to park that, put that away, just to make space on my chart. Okay, now I've jumped over to a weekly chart. So not to beat a dead horse, again, if you've been catching up lately, I've covered this, but I'm going to just show you QQQ, and this is why I'm not all in or very aggressively bullish. Number one, we're in a clear downtrend, especially on this weekly chart. We've taken out my second target, and we closed through it. This is the second week. We had a solid close below last week, and another close there. Now QQQ is not the entire market. I'd feel better right now if we were holding support there, or moving off it, or if and when we take out this trend line, and I will. If that happens, we move up, we'll recover this, take out that downtrend line there. This forms this little wedge. It's a back test really of this first downtrend line, which was broken out here. Then I will increase my long exposure. Otherwise, we could have that final jut down, a little washout move, and then I'll look to go long there. I'll lose some money on the longs I have now. I'll get stopped out. Maybe I'll be able to pivot quickly and gain some of that on the downside if that happens. But I still think there's a decent chance, based on everything I'm covering in this video, we can have a bounce and then hit those targets later. But let's look at the rest of the market real quick. S&P 500. Remember, the week is young, but right now it's holding the line right here. This is was a second target laid out way back here. We were shorting off the highs, and it's a pretty good, decent support level. Not the best, but so far it's being defended. So there's the S&P 500 at support. RSI is starting to turn up. You can see if you look really closely there, it kissed that 30 level, and it's turned back up. So that's something. We may see that. And then you have the mid caps, as I mentioned, a very important index. I don't cover them all the time, but I did give you this target earlier this year when we were up here. And you can see that has been hit each and every week. We're a hair above it this week. Close enough. Again, 425 point index right there. And so here's an index that fell and hit and is holding above support, right? So mid caps are at support. Small caps, as I mentioned, same thing. We hit my second target, 171, laid out way back here, and we've successfully hit it, and we've been moving up, not by much, but so far holding above support. So that is that. On the indexes, I won't go through each and every one. I did this earlier. XLK at support. I have support right here about 128. It was a all-time high back here. We tested, finally broke out, back tested, held successfully, and moved up. And so that's another one that hit support that level week before last, again last week, and so far holding above it now. And this is the tech sector. So if XLK can hold up, see, there's a thing now. If XLK can hold up, QQQ should hold up as well and may snap back up above that support. XLV, healthcare. Again, I'm on a weekly chart here, but here's my big support level, about 124.63, and a uptrend line still above it, so hasn't really broken down yet. Put in a divergent high, and it's been moving lower, but above support right now. And like everything, I still maintain, to me it's just a matter of, do we do this first and then that, or do we just break down here? We're coming off a big divergent high. I think a recession is all but imminent at this point, probably even started last quarter, but they never declare a recession until hindsight, because it takes 2 quarters of negative GDP growth. The data's lagged by the time the quarter even comes out. You're well past the end of the quarter. Last quarter we did have the first contracting quarter, so we just need this next quarter. And I think that's coming out this week, if I'm not mistaken, on Thursday, if I believe. And again, then often after that, they even those GDP numbers are very often subject to revision after the fact. Okay, but again, getting back on topic, the point is these are the top 2 sectors so far. Both are at, recently hit, and are above support. Okay, so hard to get too bearish when you have a lot of sectors at support. XLF, financials. Took out this support right here, 35.15, and my next support on the weekly again is all the way down here at 31.35. But on the daily chart, as I mentioned earlier, this was my daily second target from way back when, and we've hit it and danced on it for over a week and successfully held. In fact, we bounced. So you can see these little intraday spikes only to close back on or above there. So there's another sector that's holding at or above support after hitting it. XLC, communications. Remember I did the video earlier today. We were below there. This one's mainly made up of Facebook and Alphabet. But look, snapped right back to close up on the line. So here's another, that's the 4th largest sector in the S&P 500, about a 10.6% weighting. XLY, discretionary, doesn't look great there. Nor there either. So here's the thing, like I said, mixed bag. If I had every one of these at support recently hitting, especially this, here's my final near-term target 133, I'd be all in bullish right now. Or I should say we need some breakouts, a little more sign of evidence. But like I said, I'm going home bullish. Even move some money, long-term funds in a 401k. I manage for my wife. I moved that in for the first time since that last big bounce into equity. It's been cash all year. Moved into a good chunk of bonds about a little just before I went on vacation, and now moved nothing big, but a substantial portion into equities, and I'll continue to layer in. We keep dropping down. Market goes down another 4, 5, 6, 8%. I'll add more and be at a pretty aggressive long position to gain what I believe is going to be a bear market rally coming up. The next big one. We caught that first one, or at least not all of it. I didn't catch all of it. I pointed out for you guys. Hopefully some of you caught more of it than I did, but let's drill down now to the 60-minute charts. I showed you enough of the sectors, the ones that are significant. Oh wait, I didn't show you XLI. I want to be thorough in case you didn't see today's video. XLI is industrials, and this is a weekly chart. That industrials are again one of the largest sectors, about in the middle of the pack there. 90-ish is the support level. You can see all these reactions here. And then my next target, where I think we'll get to eventually, is 85.60. And again, to me, it's a matter of, do we bounce here first and go down? I'm leaning that way. And then, if I do, I'll be long, maybe not this sector. Maybe I'll have some, maybe not, or long the equity markets. It's going to bounce in line with the market. If the market bounces, and then recycle back in. Maybe hit these 200 days, swing it down for the next. This is swing trading or even trend trading, because the trend could last several weeks to even months here if we can hammer out a bottom this week or possibly next, and then swing that down. And so when you're able to swing trade like that, instead of getting a shorting the divergent high, let's say, and milking a good part of that 21% drop, you can get 10, 12, 15%, 8, 10, 12, and you can then turn around and make 50% net off trading a sector like that by gaming the bounces. That's why I have these multiple targets, and that's why I always talk about reversing and positions from long to short. All right, now we go to the 60-minute charts, and I'll wrap things up for you. 60-minute charts, very important to me, important time frame for swing trading. Again, not to sound like a broken record, but I've been talking about these divergences for a long time. I mean, first we had it here. We had positive divergence right here on QQQ. Here, let me clean up everything. Let me turn off all the lines. I'll just draw it out for you. All right, so we had a divergent low here, as mentioned, right? And as I said, ignore these 60-minute divergences at your own peril. We put in roughly equal, slightly lower low that only extended the divergence. As I always say, divergence, whether it's positive or bullish divergence, is not a buy signal, just like negative divergence is not a sell signal. They are merely conditions or indications that you're likely to get a trend reversal. What you need is the spark or the catalyst, and that's a breakout, and that was pointed out then. You broke above the bullish falling wedge there, and if you took that breakout, happened to ride all the way up, it was about 11% from there. From low to high, if you started covering up shorts, because these divergences were getting bigger and bigger and bigger, you had things coming up to support, then the whole move was about 16.5%. That's a bear market rally. The Qs went up 16.5% in a matter of 15 days right there, it shows you, which was that's the 15 calendar days, so less than 15 trading sessions. And then boom. And that boom was not random either. It was pointed out at the time. I made it very clear I was scaling back into shorts from about here to that point. And at that point I was heavy into the, fully loaded. We had so many, it was not just the rising wedge then and the negative divergence I just drew. It was the bounce back into the 200 days. It was a golden shorting opportunity. This is when that really the point of recognition occurred. At this point, the masses, the dip buyers, Pavlov's dogs figured it was another great buying opportunity, and everything was over and we were going to new highs. And that's where now people are talking about a bear market more. It's all over the place. Bear market, recession. And so what I wanted to also talk about in this video is sentiment. I have, and I'm not, if I have time, I'll get to it, the put to call ratio indicators that I use, my preferred sentiment indicators, and they are still not at those extremes that I told you. When they hit those extremes, then I'll be looking for a bottom. However, I'm not looking for the bottom, and it needs to hit those extremes that it's hit before, those levels I've covered many times in the past couple months. And I think those will coincide when we hit my deeper targets on the weekly charts of QQQ and SPY. But sentiment has certainly shot up, bearish sentiment, and I don't even need to look at the sentiment indicators. All I have to do is turn the TV on for 5 minutes. All I have to do is take a vacation to Hawaii, and everyone I talk to, what do you do? I was talking about, oh gosh, yeah, this market, wow. Everybody's concerned, they're worried, they're bearish, and it's out there. So what that's doing, it's setting up for the next bear market rally. When enough people get bearish and they capitulate, throw in the towel, or they start shorting, people that don't usually short or buying short ETFs, that's usually when at least a tradable bottom is in. So it's hard to say if we're there yet, but again, that's why I'm doing this video. That's why I sit here and talk for 20-30 minutes or more to show you all the things that make it likely whether we're going to continue lower or bounce. All right, let's turn it back on all the lines and then turn them back off. So that was that wedge. That was that last breakout. There was the bearish rising wedge. We've had a lot of different trade ops there, but most recently the divergences have continued to build. You take that divergence that we had back here at that time, take that line, extend it, and this is what's showing through on the daily chart. this positive divergence here. You have the indicators making a series of higher highs. That's what it is. This is an upward sloping trend line on the PPO, upward sloping trend line on the RSI. If you can't see it, you can just stretch it out there, and then you can see it very clearly, like that, right? And it's even getting steeper here more recently. Same thing on the RSI, divergence, divergence, divergence. So that's like I said, what is giving me one of the things that is keeping me at this point in time long after pivoting recently. Okay, and then you can draw a trend line here. You can see, rough downtrend line there. A little, you want to just use this as your divergence point. You can use that, and turn on the levels again. 60-minute chart. You have my targets. They were laid out before I left town, and second target's already been hit. We had that negative divergence on the futures at that point. They played out for more than I thought they'd be, but then we had that nice undercut. So let's finish this video real quick with the futures. I've sat there and laid out all the reasons why I'm long, but also a lot of the reasons why I'm not aggressively long. There is certainly, it's not an all-in moment. I can make a good enough case to say, no, trend's still bearish, there's no reason to get long. At this point in time, you should remain short if you're short. I could certainly make that case, and if that's what you're doing, great. Just don't get married to that position. This is where I'll tell you where you might want to consider stops. The same point that I'm going to be looking to build to long positions if this happens. Same level I gave you Sunday night right here, or yesterday, one of the two. 12, about 1285 on NQ. It's a big level. We had multiple rejections there so far. And we had a divergent low most recently here on the 60-minute chart of the futures. That was a divergent low. And then we had that whipsaw. And like I said, today, boy, they sure tried, but they did not even equal. So far, they dropped down and they bought it up before the lows. So they didn't undercut the lows. That would have been, and still will be, this could happen tomorrow. It could happen tonight. That's going to be quite bearish, especially if it's anything more than a whipsaw. Because let me show you. You got to look at these divergences. If I take this line right here and I extend it out, well, it's not going to come in right there. I'd have to move it down a little bit, because if we undercut and then reverse, this divergence line will be intact, but we'll make a lower low. As long as it's not taking out these lows, we're going to have that divergence for a while. So that's why if tonight we dip down there, I wouldn't automatically sell all longs and reverse to a short. I'd watch it. I'd probably get taken out. I'll be asleep, so I'll have staggered stops like I always do. They'll take me out, and then if I wake up in the middle of the night, like I sometimes do, or get up early and I see an opportunity, especially recovery, that's what makes me want to get long. If I see a drop, big washout move, and then a recovery back above the recent lows, that would be another whipsaw, just like we had right here. Remember, that was double bottom, very well watched low, took it out briefly, they ramped it up hard, and so as of now, that bear trap or potential bear trap is still in play. This is not the ideal action. Usually when you get a bear trap, they don't look back. They just keep roasting the shorts. That's usually what happens, but it's not always what happens. So that's it. And this is the level I think we can really run. If and when 1285 is taken out, I think you'll see a very strong, sharp move up. A lot of short covering, a lot of buying to at least this downtrend line. That downtrend line, by the way, this is only a 1-month view on the 60-minute time frame. To see it, you have to zoom back out to a 2 or 3 month period, and you can see my downtrend line comes off these highs right there. It comes and captures that high, that one there, and it also comes in around now it's going to come in before my third target zone. So it would look something like this. If we run up, hit my hit that 12.085 level right there, then break out, probably run, hit the trend line, and then maybe go on and break the trend line to run up and hit T3 zone right there, which is both the 38.2% Fibonacci retracement and some pretty good price resistance. Try to quantify it for you. If T3 is hit, you're now talking about a 10% rally from where we're at today, give or take. I know this is a busy chart, a lot of levels here. Key takeaways are, again, positive divergence on the 60-minute time frame. And so far, we're holding those recent lows, which are also part of a whipsaw, aka bear trap. And then on the S&P 500, ES, same thing. It's the 60-minute chart, 1 month of, no, 2 months of price history. Here's our positive divergence right there. Just like NQ, we had a double bottom low with a brief whipsaw, aka bear trap, once it was recovered, and we remained comfortably above it all day today. So that I don't see any reason to exit any long positions taken after that whipsaw unless that's taken out. Potential downtrend line right here. It's not the best. It's only a couple reactions. So we'll see what happens. But this was the level I told you the other day. I wanted to see both this level. That's 39.51 right there. I needed to see that and that comparable level I gave you on NQ. Well, as I mentioned, ES popped it, but not NQ. And that is a must for me. I got to see if I have comparable levels, like comparable support levels on both indexes, they both need to get taken out. Because this is common. One will break out, and if the other stops, just like NQ did, back there, zoom back in, that's what checked it. So this is where I think I differ from a lot of traders. Some guys or gals might trade the ES, S&P 500, and they would have took that breakout. Even if I was trading ES, I wasn't. I was trading NQ at the time and RTY, but I wouldn't take in the ES breakout because at the same very time it broke out, NQ was at resistance and failed to break out. It got rejected. So that's why I sit here and spend 30-40 minutes covering multiple charts on multiple indexes and not just one index, even if that's the only index I happen to be trading. And last but not least, RTY, because I mentioned the small caps a lot and trade the small caps. Here's a downtrend line. This is a hourly chart. Here's a level coming back from the end of March right there. That's about March 30th. Downtrend line that's a likely target. Remember, right here we hit my almost perfectly my long-term target on the weekly chart, T2 I think it was, 171 on IWM, and so that was at a point where I covered all my IWM or small cap shorts and reverse long, and so far those are good. You have a bullish falling wedge there. You broke out at the same exact time we hit the long-term target. I mean, you can't ask for better than that. That's that 60-minute divergence. It tells me to cover shorts and get ready to go long. And then when you on that one, there's a case of simply going long at support. I'll go long in one of two ways. A buy signal, or an objective long entry, I should say, for me is either a pullback to support and or a breakout above resistance. In this case, we had both. First, the pullback to support, 171 on IWM, and then the breakout above the 60-minute bullish falling wedge. And if you trade actively like I do, you watch these, look for the next 60-minute divergent high, and that's where we had a little rising wedge. It broke down, give us a little correction, but so far they've bought up each of these pullbacks well above that recent low. So this is constructive. This is an index that so far has bottomed. Time will tell. Maybe I'm wrong. We just shoot down, and then I have deeper targets on IWM that might get hit a lot quicker than I expect. But as of now, I think we can run up to that trend line right there. That's an ideal target. There's also some nice price resistance around there. And to quantify it for you, that would be if hit. I didn't mean to move that line. I'm trying to grab where we are right now. That would be about a 10 or so percent, 10.5% rally. So there's a common theme. Every time I measure it, where I think we're looking at probably about a 10% rally, give or take. And now I'm going to wrap it up here at 33 minutes. I may have just wasted 33 minutes of my life and yours if we just go down. But if we go down, hopefully I didn't waste your time, because you know the levels to watch. You can see right here on IWM or RTY, small cap futures, we have twice today we tested 1730. So near term, if you want to set a tight stop overnight, if you don't want to wait till that lows, you could put a tight stop at 1730. Or what I like to do, I stagger my stops. I don't like to be taken out all or none, especially in a volatile market. It drives me crazy to see a stop get clipped and taken out of an entire position. So I'll stagger. That means one stop a little bit below, not enough that they can undercut it briefly, because that's where the algos know all the stops are sitting just below or right at 1729. So I'll set one there, and then the next one will be just below that, and that's it. And so if they take me out, so be it. They take me out and then they ramp it back up and recover these levels, I jump right back in. Otherwise, I can decide if if the breakdown sticks. Maybe if there's enough room to my next targets, I'll jump back in short and try to milk a good part of that back. All right, guys, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.